All right, welcome back, everybody, to Phenom Group's weekly State of the Market. I am your host, Seth Golden, and that looks like fun, or anything but, right? Stock market up or down next week. Probably not the duration or time frame you need to be considering. If you're worried about stock market moving from one week to the next, I'd be willing to bet you are going to feel like this guy trying to balance from one week to the next, and that is a difficult task. With that being said, it's easier to know what's going to happen than when it is going to happen. That quote from Dan Rasmussen. So what I would say is just stop focusing on when, focus on what you know, and plan for the inevitable. In the context of the 2021 market, it's a matter of, at this stage, it's a matter of when is the Fed going to taper? Who cares? We go through this just about every week, and probably going back about 3 months now. When is the Fed going to taper? When are taxes going to be raised? Again, I'm in the I don't care camp. We know that the Fed's going to taper. That's what matters most. I'm still on the block when it comes to if taxes are actually going to get raised. And which taxes? Personal income taxes? Is it corporate taxes? Is it capital gains taxes? There's a lot of nuances here to work out. They can't pass an infrastructure bill, let alone agree to tax legislation, in my opinion, come next year and during a mid-cycle election year. So, again, stop focusing on the win, focus on what you know, and plan for the inevitable. The near-term future, all the conversations around Fed taper, and we know they're going to taper. It's the right thing to do. When they taper is less consequential than the fact that they will taper. Just have a game plan for, if price happens to weaken during, the tapering messaging, the plans that'll be marched out from the FOMC. Have a plan. That's it. That's your job. We had a lot of price targets raised this week with respect to the S&P 500 for year-end price targets, including Wells Fargo. Along with their price targets, they basically gave their 10 risks, their 10 biggest risks to the market: inflation, Delta, the debt ceiling, everything is peaking, Fed tapering, tax increases, equity valuation and rotations, China slowdown and crackdowns, complacency, commodity exposure. In a term, when it comes to tax increases, and I know this is, again, well, when they raise taxes, it's going to hurt the market. No, it's kind of like tapering. If they feel confident enough to taper, that's kind of a sentimental dissemination of their feelings about the economy. We're in a good spot if they're feeling like it's okay to taper at this point in time. And it's probably not going to happen until closer to the end of this year. The messaging will come out sooner than that, of course. So when it comes to taxes, this is a chart. If you're worried about taxes, the market actually tends to do pretty well when taxes are raised. 1950, the personal and the corporate tax were raised. The market was up 22%. 1951, 1952, again, personal and corporate taxes. Market sometimes doesn't like when they raise the capital gains tax. We were down here. I'm sure it wasn't because of that. Some of the biggest increases in social welfare spending historically came there in 68 through 69. Again, capital gains tax was raised in 1970, 1971. Market was up double digits. 1972, up double digits. 1976. Again, check all the boxes here. More often than not, it's a non-event. Don't get me wrong, you can have volatility around the dissemination of that legislation for tax increases. But beyond that, everything reverts to earnings. What are earnings doing? Tapering? Okay, good, fine, great. We might get a pullback. It might finally be that 5%. But what are earnings doing? Raising taxes? Okay. Might get a volatility event around that. But what are earnings doing? Every week they seem to march out on CNBC, a new guest that tells you not to buy the dip. Last week on Tuesday, Jonathan Krinsky of Baycrest, he's their chief market technician. Remember I said earnings a little bit ago? That's fundamentals, right? He's a chief market technician. He was telling people, don't buy this dip last week. If you hadn't bought that dip last week, you would have missed out on a 1.8% rally in the S&P 500. And again, to all-time highs, 4,500 plus just yesterday. They do this every week. Imagine missing out on each of those dips. We've had a 4% dip this year. We've had several 3% and 2% dips this year. Add them all up. If you had missed each one, the average annual return for the S&P 500 dating back to 1950 is about 9%. You missed out on every one of those dips. You missed a 9% move, just each of those times. Had you only bought the dip for 1%, each of those times it would have netted you a 9+% gain this year. I don't know why CNBC does this any more than I know why they brought on two of the Fed presidents, Robert Kaplan, the Dallas Fed president this morning, and James Bullard this morning, interviewed by Steve Leisman. Remember, Steve Leisman last week broke the news that, you know what, the Fed may actually start messaging their tapering plans sooner than expected, and even start the tapering process before the end of this year, right? Market had got a little squeamish and whatnot, gave you the opportunity to once again buy a dip. And so to bring on those two Fed presidents that are not voting members this morning, James Bullard, the St. Louis Fed president, Robert Kaplan, the Dallas Fed president, to basically just reiterate what Steve Leisman told us last week. And by the way, those two Fed presidents are not voting members this year. They are not voting members. What is the point of this programming any more than this gentleman here telling you not to buy the dip? Like, what are these people looking at? Remember, I said he's a chief market technician. He's the chief market technician of Baycrest Capital. Nothing he had mentioned during this broadcast had anything to do with earnings. Are we missing something here, technicians? Are we missing something in the big picture as to why the market continues to get bought rapidly and surges to new all-time highs? Are you missing a key driver of the market? Earnings. Earnings. Apparently, Jonathan Krinsky is missing the fact that, and we've gone over this chart representation before, these 2 sigma events that have happened quite frequently this year. We've had 10. It only takes the market 2.5 days to recover. Don't buy the dip. Somebody's not following their statistics. Somebody's not, monitoring their historic data in that regard. Stay invested. Maybe the market does get the Fed tapering message in September at the next FOMC meeting, and maybe indeed it does have a bigger, consolidation period. Maybe we get the 5%. We've gone to today is day number 203 trading days without a 5% correction. The chart before you tells you the positive returns by time frames. Now, from one day to the next, it's a toss-up. Market could be up the next day, could be down the next day. 1 week is starting to favor the bulls. A month, really starting to favor the bulls. 3 months, the average year is going to be positive. The average year. 2-year period, forget about it. Market's going to be positive. 3 years, over a 30-year period, the market is higher 100% of the time. Just stay invested. Forget about timing the market, hedging, and all these different types of strategies to lessen your drawdown. If your strategies to lessen the drawdown involve hedging, that demands timing in and of itself. You have to time the entry. You have to have the right premium. You got to time the exit. Hope that, again, the market does not have a gap open whereby that hedge is found underwater and the instrument you are hedging against is basically back to even. It's about time in the market. Stay in the market. I'll try to time things. We've gone now, again, 200 plus days. 200 plus days without a 5% drawdown. It's one of the largest streaks in history. Clearly not as big as this one, this one, this one. 1965, this one here. So the S&P 500 performance following the final day of at least 200 consecutive days or more without a 5% correction. We're all expecting a big, when that streak ends, we're expecting this big drawdown, right? Because we've gone so long without a more consequential drawdown. The next one must be big. Sometimes it is, sometimes it's not. Could just be a garden variety. 5% correction, 10% correction. But after these prolonged streaks, when we look at the 1 month performance from the longest streaks or all the streaks that were over 200 trading days without a 5% correction, the 1 month return is actually positive. It's a very small, positive. It's 0.7% there. But more often than not, the market is actually down. The percent positive 1 month after that after that streak ends, only 29% of the time is the market green. 2 months later, again, market tends to be green only 29% of the time. We go further out, 3 months later, market is up more often than not. 6 months later, market is up more often than not, and the returns get bigger. Now, these are in the 50 percentile, so it's not great, but still the market is usually higher. 1 year later, market is up only 43% of the time, but when it is, the average gain, 8.5%. The maximum drawdown after these 200 consecutive day streaks without a 5% correction, indeed, it is double digits. The average drawdown is 14%. 14%. So a little more than the garden variety, I guess you could say. A little more than the garden variety. We are at 203 days without a 5% correction. It's been 68 days since we've even had a 3% correction on a closing basis. And that's 3 times the average seen during the secular bull market since the 1900s. It's been 350, a full calendar year, without either a 10 or a 20% correction, while the averages are 331 days for a 10% correction and 1,105 days for a 20% correction. So we are beyond the average for a 10% garden variety correction. Coming into this week, we expected to see, some pretty good things out of the market based on this particular study here from Quantifiable Edges. The Russell 2000 closes down over 5% in 6 trading days. This goes back to last week before Thursday. So up and through Wednesday, the Russell 2000 was down 5% in 6 trading days, while the S&P 500 does not even close down 1% over the same 6-day period. The forward returns for the S&P 500, when this criterion has happened in the past, the next day return up 1%, 2 days up 2%, 3-day return 3%, 4-day return, it's pretty good out to 5 days, right? And the percent positives are in the 90 percentile, 2 to 5 days out when this has happened in the past. That's a decent enough, look at when it's happened. 1987, 1998, 2000, and present. A lot of boom bust scenarios that come to mind when we think of 1987, 1998, 2000, right? A lot of boom bust scenarios. The S&P 500 coming into today's trading session with respect to this study is up 1.82% through day 4, which was yesterday. So up nearly 2%. Today is day 5. Today ain't going so well. It's SOTM day. Red markets tend to follow the state of the market day, unfortunately. And what about the Russell? Since we talked about the S&P 500 returns, what about the Russell? Well, this from the Stock Traders Almanac. You can see this goes back to 1979 through August 20th. We tend to see a rise in the Russell into about mid-September. We tend to see a pretty good rally in the small caps. Indeed, the small cap Russell and the IWM ETF had one, closed below its 200-day moving average last week. Ever since then, it has rallied pretty significantly. Those buyers came in. That 200-day moving average proved to be just the support that investors needed to breed that confidence to go out there and buy that dip in the Russell, in the small caps. All right, and this is pretty unique also. Yesterday completed another 5-day win streak for the S&P 500. We had a 5-day win streak back here in July, a 5-day win streak just 2 weeks ago, and another 5-day win streak here for the S&P 500. There's also been a very strong tendency in the past year to give back. Once you've had a 5-day win streak in the S&P 500, that's what this chart shows. For whatever reason, if we go back a full year, all right, August to August, whenever we've had these 5-day win streaks, which are highlighted in yellow, we tend to give back a lot of it, if not all of it, and then some. We give back a lot of it. Another 5-day win streak, we give back a lot of it. 5-day win streak in July, and we have the next dip. 5-day win streak, the next dip. We just finished a 5-day win streak, down 17 points here, almost 0.5% in the S&P 500 on day 6. So it's, again, we get frothy, price gets extended a bit. Traders want to lock in their profits. It's just human behavior. Is there anything actionable here? Patience, maybe, right? You don't want to chase that rally. Maybe, the stocks on your shopping list. Price just isn't right for you. Wait for the market to breathe in. Wait for price to come back to you. Express some patience, some discipline. Here's what we're acknowledging to be our Phenom Group patience indicator, if you will. This is the percent of S&P 500 stocks at their 5-day highs. Coming into today, it jumped up to 56+%. Stocks trading at their 5-day highs. And usually you get to these levels, these extended levels above 50%. That's about it. I mean, you could go a little bit higher for sure. But this tells you, be patient. More than likely, breadth is going to correct. Prices are going to come down. We'll get a little consolidation in the S&P 500, our patience indicator. The percent of stocks trading above their 5-day high is above 56% coming into today. And lo and behold, right, here we are today with a little bit of price consolidation, with still yet one trading day left to go in the week. Indeed, this has been literally our slowest trading week of the entire year. Price has gotten ahead of itself in terms of the stocks and ETFs that we trade here at Phenom Group. So we were just waiting for those stocks to come back down, for the market to consolidate a little. And this particular breadth indicator helps us to recognize whether or not we're close to that point of consolidation. All right. Now, leading up to today, breadth has been really strong. When you look at the NYSE up volume, going back to Friday, we've had 3 days in a row where the up volume on the S&P has been greater than 75% of volume has been to the upside versus, of course, to the downside. And that's pretty rare. I mean, you can see here on the chart the number of times that has happened. This is from Sentiment Trader. Seemingly, whenever something negative triggers, buyers show up immediately. We saw on Monday that the S&P 500 approach to its former high was accompanied by a negative McClellan Summation Index, or NYSI would be the ticker symbol, and more 52-week lows and highs. No matter, stocks continued to rise and breadth turned around. The switch was dramatic enough that more than 75% of volume on the NYSE flowed into advancing securities stocks. It happened on Monday and on Friday of last week. Tuesday, we had an 80% up volume day this week. Over the past 3 years, this is only the third distinct time that the 3-day average of NYSE up volume has neared 80% over the last 3 years. Here, this cluster, and once again here. So I think it's safe to say that a 5-day win streak with the aforementioned percentage of stocks trading at the 5-day highs, breadth has improved since coming into the week with relatively neutral breadth readings across many breadth metrics at the start of this week. On Tuesday, we had an 81% upside volume day. It proved the third straight day, 76% or more, which is also highlighted in the breadth study above from Sentiment Trader. Now, what, can we glean anything positive about future S&P 500 returns when you've had a cluster of 75% or greater average upside volume days? Well, Sentiment Trader says since 1928, there have been 86 non-overlapping periods with 3 consecutive days of 75% or greater up volume. Across all time frames, the S&P 500's average return was well above random. The average drawdown was a small fraction of what the draw up, or the positive return, and there was a much higher probability of a big rise rather than a big drop. Breadth matters, folks. Yeah, but Robert Kaplan and James Bullard were on today talking about, tapering as soon as possible. And Jerome Powell is going to give his speech at Jackson Hole tomorrow. The flows have been in motion, basically since the pandemic bottom. The fund flows have been in motion. They're still in motion. What does tapering have to do with earnings? You get about a volatility, good, fine, great. Put it to good use. The breadth study that we showed before, the NASDAQ, the Russell seasonal pattern, to be expected consolidation, and don't leave this out. Don't forget, breadth tells you about flows. It tells you about what investors are doing with these dips in the market, like we had last week. We talked about the Summation Index, the NYSI, that was noted here in the notes from the Sentiment Trader. McClellan Summation Index was negative. It was negative. This is where we came into the week. This was the start of the week. This was in our weekly research report at phenomgroup.com. -7 for the New York Stock Exchange McClellan Summation Index. It's a measure of advanced decline lines. Here's where we are as of yesterday, in positive territory. Again, breadth is mightily improving here this week. I know, market's down today. I know, Jerome Powell tomorrow. I get it. Have a game plan. If the market gets weak, execute your game plan. Nothing's changed. Tapering does not change anything. For more context around tapering, what I would say is it's not that they're not buying assets, treasury securities, mortgage-backed securities at all when they start tapering. They're just buying less. So they're still accommodative. They're just a little less accommodative. That is not going to disrupt the economy. In my opinion, the only thing really that we could see disrupt the economy is from another exogenous event. Indeed, maybe something does go wrong, or, with regards to the COVID pandemic. Maybe the next variant demands an absolutely new vaccine. But if you want to live in that kind of world, that kind of pessimistic viewpoint where something like that is the high probability, even after what we've seen over the last 18 months, where the variants are manageable with the existing vaccines, be my guest. The pessimist doesn't get paid in the market. I'm sure if that's the sentiment you have about a future variant, there's probably a lot of pessimism that underlines your market participation and probably lends itself poorly to your annual returns. Again, it's not an opinion. Pessimists don't get paid in this market. I do fine with bonds. You're not an investor. Go away. Leave me alone. You're not. Well, I buy gold. You're not an investor. Go away. Leave me alone. Gold will do nothing for 10 years. That's not investing. The S&P 500 is up 5-fold over the last 10 years. Don't talk to me about gold. If you're an investor, it's about risk. You have to engage risk. Equity market's going to deliver more in the way of yield than any other asset class. Maybe not Bitcoin. I get all that. That's still something that's developing. All right. We need more time with Bitcoin and crypto assets and things of that sort. I'm willing to see it play out. All right. Another one here in terms of, talking about breadth, recognizing that breadth has improved. And, Jonathan Krinsky, that came on CNBC saying, don't buy the dip. He spoke to breadth. He spoke to the fact that, there's a number of stocks, a number of sectors that aren't working. They can't get off the mat. Well, again, you have to take the whole cycle. You have to be able to understand the whole of this new cyclical bull market. What's been transpiring underneath the hood. You've got to have a running dialogue, a running relationship with the last 18 months of this new cyclical bull market to understand why the S&P 500, the NASDAQ, the Dow haven't had a serious correction, and why you should continue to buy the dips until proven otherwise. Without that ongoing relationship, dialogue, what Jonathan Krinsky said was, these stocks aren't getting up. They're not bouncing. You could have said the same thing with Apple, folks. You could have said the same thing with Apple, which went into a correction here back in February and bounced, but then it came back down, right? So from February to basically June, you could have said, the market's going to go, even lower. The market's going to have a serious correction because Apple it won't stop going down. It's not bouncing. It's not working with the rest of the market. And then it did. Why can't we give things time? Technicians. See, we were buying this. We were buying the NASDAQ. We were buying Apple. It's one of my core holdings in the Golden Capital portfolio. I recognize when breadth weakens, but I also recognize what's going on with earnings. If you didn't buy that weakness in Apple, if you didn't buy the weakness in growth, if you didn't buy the weakness in tech, in the NASDAQ, because they just won't bounce and they're underperforming the rest of the market for 3 months, you don't have 3 months. You don't have 3 months to wait as an investor, as a trader. You don't have 3 months to wait. Stop it. And again, it's about earnings. If you have your touch points with earnings, breadth makes more sense. The whole of the market dynamic makes more sense. Investors are not stupid for, continuously buying the dip. They're following the trajectory of positive breadth revisions in earnings. This chart here from the sentiment trader shows the S&P 500 stocks in correction, going all the way back to January of 2017. And this is the S&P 500 at top. Look at this. You had extremely strong breadth here, and then breadth weakens. That's another characteristic or condition of markets. You know, once you get this huge breadth thrust, the only thing that's really possible over time is to get a breadth divergence, which is why I often say it's not the bearish breadth divergence that matters. It's the overall level of the breadth indicator that matters. But here we've had a bearish breadth divergence. More stocks were in correction territory. More stocks were in correction territory than not. So you have weakening breadth here. When it's going up, that means more stocks are going into correction territory, but the market's still going higher. Strengthening breadth means you have less stocks going into correction territory or in correction territory. Market's still going higher. It's a cap-weighted world, folks. Indexes are cap-weighted. Right now, we've had, more stocks going into and staying in correction territory, but the market's still going higher. Those cap-weighted stocks, those mega cap and large cap names can hold up the indices. There's a lot of crap underneath the surface. There's a lot of bad companies in the market. Don't buy bad companies. All right, the NASDAQ percent of stocks above their 50-day moving average, kind of an update of where we are. Man, it was just last week, 22%. We've rocketed higher in the NASDAQ, not the NASDAQ 100, but the NASDAQ at 41% now coming into today. Is that good? No, not really. It's the weakest of the large cap indices when it comes to the percent of stocks trading above their 50-day moving average. But just like the S&P is a cap-weighted index, so is the NASDAQ. So what we want to do is we want to look at the NASDAQ 100, because that's what drives the NASDAQ. That's all your large mega cap names, your growth stocks. And the percent of stocks trading above their 50-day moving average there and remember, we dropped to the lowest level last week. And the stocks trading above their 50-day moving average in the NASDAQ 100, we dropped to the lowest level that we had seen since mid-June. And we're right back basically above the 50-day moving average at 70% of stocks. The NASDAQ guides the NASDAQ. The NASDAQ 100 guides the NASDAQ because it's a cap-weighted index. Here's a perfect visual aid when it comes to, who leads what in the NASDAQ. This is the NASDAQ index, Comp Q, relative performance to the NASDAQ 100. The NASDAQ composite index is usually weaker than the NASDAQ 100. Bounced here, bounced again, and recently just bounced also. It seems to like this level. But again, the NASDAQ composite index is relatively weaker than the NASDAQ 100 over time. We just crossed over 15,000 in the NASDAQ also. Woohoo, party streamers. What are those below things? Anyway, the NASDAQ crossing over that 15,000 point mark this week with I think it's a 19th record high for the NASDAQ. Should we be anticipating a pullback after reaching this new 1,000 point crossover? Well, that's what this table tells us. Of all the 1,000 point thresholds the NASDAQ has crossed over time, the only one that it never traded back below after crossing it was 6,000. In 2017, it never had a downside cross. So there's a gap down there that never got filled, I'm willing to bet you. Now they say all gaps get filled. It's more like 80 to 90% of gaps get filled. But I mean, this is just one occasion where we've crossed over 1,000 point threshold Out of all of these other times, basically we should anticipate the NASDAQ crossing back below 15,000 at some point here. Katie Stockton, another market technician at Fairlead Strategies, speaks to this point as well on CNBC just yesterday. She recognized that the NASDAQ 100, NASDAQ 100, the 20-day moving average turned down last week, often associated with pullbacks. And September sucks. September sucks for the S&P 500. It also sucks for the NASDAQ and the Qs, the NASDAQ 100. Here is the seasonal chart going all the way back to 2002 or 20 years. These are the Qs when they closed higher. Here's the month of September. And as you can see, it's a toss-up, basically 50-50 since 2002. But the average return for September since 2002 is actually negative by 0.1%. So September not really favorable for the NASDAQ. However, get into October, things get better. 63% of the time it's been positive going back to 2002, and more than a 2.5% average return. November, we're on the cusp of the fourth quarter, folks. We're almost there where you get that nice seasonal lift. The November to April timeframe is the best 6 months of the year to own stocks. Best 6 months of the year. In fact, up 78% of the time going back to 1950. The market is up from November to April of the following year. If the NASDAQ gets weaker, good, fine, great. Again, earnings, that's my North Star. That should be your North Star. The Fed's going to taper. We don't know when. We can't control that. What we can control is what we do when the market does weaken. Have to have that game plan. Refer to the game plan. When you refer to the game plan, you take the emotions out of it. Price gets into your zone for the first layer, execute. Keeps going down to your second price zone entry, execute. Check in periodically, of course, with what are credit spreads doing? Is the economy still growing? Are we still in an expansion cycle? Rectify that with the incoming weekly economic data. Is the yield curve inverted? No? Okay. We've got all of our buy the dip indicators satisfied. Execute the layers. During that weakness, with Apple, with tech, with the NASDAQ, with the Qs earlier this year, we were buying TQQQ. That was part of our game plan. In March, we outlined our strategy to build a core TQQ position as the NASDAQ went into its 12% correction. And then it had a nice relief rally, and then it corrected 8%. TQs went all the way down to the 60s. And we were buying and scalping and building a core holding with those scalps. I was surprised when I looked at the Golden Capital portfolio and where our gains, the majority of our gains came from this year or year to date, have been VXX, which is the top holding, short holding in the Golden Capital portfolio. But that's only followed by a 44% gain in TQQQ. Apple has helped. Pepsi has helped bigly as well. Couldn't fit everything on the page. So, but if the NASDAQ's going to have that seasonal weakness, if the overall market is going to have a bigger correction, be more than happy, to reignite that game plan. A lot of trends coming into or going into the month of September and coming out of the month of August. The number of months per year to make a new high. Every month so far in 2021 has seen a new high. We are 8 for 8 this year, folks. Only once have all 12 months made an all-time high, and that was in 2014. Good year. I think it was a 13 or 14% gain that year on a total return basis. It was also the final double-digit year of a 3 consecutive year period. 2012 double-digit return, 2013 double-digit return, 2014 double-digit return. 2013 was the taper messaging from Ben Bernanke. You've heard me say that before. And the market was up 30+% that year, followed by a double-digit return in 2014. Could we have a double-digit return in 2022, make it 4 years in a row? Extremely rare. This chart goes all the way back to 1980. The only time that we've had it 4 years in a row of double-digit returns was 95 to 99. 95 to 99. So it's possible. It's just not highly probable based on the data. The S&P 500 has made 9 new highs already in the month of August. That's the most since 1929. Yeah, I get it. Nobody wants to hear that date any more than they want to hear the date 1987 or 2000, right? Only twice has the S&P 500 logged 50 new highs through the end of August. That was 1964 and 1995. So what happens next to the S&P 500 after such a streak of record highs in the year? We've got 51 new highs here in 2021. Well, the rest of the year in 1964, the S&P 500 added another 3.6%, while it added 9.6% in 1995. Below are all the years, so if we loosen the criterion a bit, right, less than 50, but still, a lot of new highs for the year through August. Let's say 30 new all-time highs through August. Again, it hasn't happened a whole lot, but 1, 2, 3, 4, 5, 6, 7, 8, 9 times it's happened. The average return is 4.7%. The only downtime, and it's a big down one at 25% the rest of the year, was 1987. It's the only other time. Excuse the data. Again, it says here, the average return the rest of the year is 4.7%. But if we take out the 1987 crash, it jumps up to 5.4% return the rest of the year. As I said before, NASDAQ, it sucks in September. It does for the S&P 500 also, no matter how we look at it. Since 1950, just the last 20 years, just the last 10 years, or just post-election years, all the candlesticks are down in September. Worst being about 1% over the last 20-year period. Keep in mind, that's seasonality. And this year, the market has bucked that seasonality. Look here at February, all right? Post-election year, which this is, supposed to be down, wasn't. Past 20 years, supposed to be down, wasn't. Look at June. Again, post-election year, supposed to be down. Past 20 years, supposed to be down. The June swoon. Didn't happen. Market was nicely positive in June. So grains of salt, water off duck's back. As I often say, the seasonal data should be paired with other data. What other data do we have? Well, if we carry this positive return over the next, we got 3 trading days beyond today for the month of August. We came in today up 1.8%. If we can finish the month positive, that will be 7 months in a row. That'll be 7 consecutive months. The only down month was January. Only down month was January. Should we be up 7 months in a row? Well, after a 6-month winning streak, the 1-month forward return, which would be August, the win rate is 63%. The average return, just about 0.1%. Maybe things are going to get bad here in the final 3 trading days of the month. But indeed, most of the time the market is higher 1 month later. What about 2 months later? That'll bring us into September. It's the same when it comes to percent positive. 63% of the time the market is positive, but the average return is better, about 1.25%. 3 months later, that'll of course take us into October and the fourth quarter. Gains get larger, returns get larger, so does the positive percent rate at almost 79%. So again, we got seasonal data and we've got the trend, the momentum data that tells us we should be looking for additional gains. Could tapering? Yes. Again, yes, that could throw us off of this data and into this. All we have are the probabilities and the flows. We know this momentum. We know what market participants are doing every time there's a dip. And again, I think it's all related to what's going on with positive breadth revisions and earnings. If the Fed tapers, are we going to get, just a new regime of volatility? Will the VIX begin to rise when the Federal Reserve begins to taper its bond purchases? Here was when tapering started back in 2014. This looks pretty docile, the VIX, constant. We didn't start like a new elevated regime. We did not. This was the taper tantrum where you did have a spike, but it normalized. It normalized to the trend. So tapering doesn't really have any kind of ominous relationship with the VIX. What about when they start to actually raise rates, right? Because we're also hearing that some of the Fed members are in favor of raising rates at some point, maybe in the second half of next year, late 2022. Well, this chart is when they started raising rates in 1994. It looks a little bit like, indeed, they may have. This was a shock. That's why. 1994 was a shock because they raised 50 basis points. So indeed, that was kind of over tightening. That scared market participants. But here's where they started raising rates in 2004. Look at what the VIX is doing. It's going down, 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 down. People know when the Fed is going to raise rates. As long as they do it a quarter point at a time and the market can absorb it, the economy can absorb it, it's fine. They kept raising rates into 2007. They stopped. Then, of course, this had nothing to do with rates and everything to do with the financial crisis. Here again, they started raising rates in 2015 really, in December of 2015. Here's the VIX. It kept going down. Here's them raising rates in 2016, 17, 18. VIX is still going down. I would say no. If you surprise the market, if you surprise the economy, yeah, with a 50 basis point, you got problems. You got problems. But other than that, there's really no relationship or no signs of ominous VIX action related to raising rates. We also hear a lot about, well, the market's only up because of quantitative easing. Indeed, quantitative easing helps the size of the gains. Here's in the blue shaded, we have quantitative easing up 26%, 09 into 010. They stopped quantitative easing here. That's why it's shaded in gray. Market still had a positive return. They started QE2, and indeed, you got double-digit returns. They stopped it, and from 2011 to 2012, those are not bad gains, 8.7% average annual gain there. QE3, indeed, you got double digits here from 2012 to 2014. I get it, okay. But look at when they stopped. From 15 to 19, you averaged 10% annual gain per year without QE. So you could make the argument that QE bolsters the returns, but we still have positive returns with or without it. Don't fall prey to some of that, burr nonsense that's out there in social and financial media. So with that, I hope you enjoyed this latest edition of our weekly State of the Market. If this is your first time watching our video, hopefully some of this quantitative and technical analysis helped, level set what, some of the imbalances that you may feel from, markets that are topsy-turvy and tend to, one week we're up, the next week we're down. Stay on an even keel, and remember, there's things that are out of our control. What we can control is establishing a game plan and making sure that our North Star earnings is always in focus. With that, this is Phenom Group's Weekly State of the Market. I'm Seth Golden. You have a safe trading week.